It feels different. Es que es distinto. No importa si estás en Saturno, en la Tierra. Al final se necesita una buena charla con un amigo, especialmente if he happens to be an expert. Quien la apueste, at the end, it's all you can get. Welcome, everyone. We're in episode 5 of the All You Can Get episode, season 2. And this time I am very excited to bring someone on that, I find very unique. His LinkedIn voice is very unique. What he's doing is very unique. And every time that I've talked to him, I just have like a lot more questions, and I probably just dig into another different layer. I feel like you're that kind of person that has played like 10 different lives within one. We've all played one and you've played like 10. So Cole, first of all, welcome to the All You Can Get podcast. I'm really excited to have you here. And why don't you tell us a little bit about yourself? How in the world did you came up to RealPC? And what I really want to know, all the companies that you have done, what is the one-liner for each? So like the listeners can understand your broad background.
Okay, interesting. Thanks, Valentina. It's a pleasure to be here. And I could say the same about you, by the way, as well. You and I are cut from the same cloth. It's a founder thing, I suppose. My short story is that of being a career founder. First off, believe that true founders are inevitably kind of drawn to finding a lowest common denominator of value. It's kind of how we make money and how we push value back to either our investors or our counterparties or, our families, even our friends. It's just about value. So my education, first off, was in naturopathic medicine. I have a degree there. I went to be a naturopathic doctor, opened up a chain of clinics and a line of supplements. And while doing this, I recognized one fundamental point of value. Patients would come and see me and they would say one thing, I want to get healthier. And I would say, great. Diet and exercise, pretty straightforward. Diet was a conundrum. Exercise was pretty easy. Get a good pair of shoes, go for a walk. People can afford that and they can do that. The diet piece was really difficult. Can't find it, can't afford it, don't know how to cook it. I'm allergic to it. Food was really strange and very hard for a lot of people. So as a founder, I kind of recognized pretty quickly I wanted to try and find a solution for this. And even as a naturopath, I wanted to find a solution, which led me to kind of discovering a type of food that was interesting, nutritious, delicious, and easy to prepare. And I discovered cheese, of all things. I discovered small batch, artisanal, handcrafted, handmade cheese, of which when I was living in Toronto, Canada, was not available anywhere. There's like 11 million people who live in Toronto, Canada, and like all the cheese in Toronto, Canada was orange, right? So it was like these kind of like connections. And I realized I had to sell my naturopathic business and move into the food world because I realized that if you don't eat, you die. So this has got to be the lowest common denominator of value. And then I was running my food company and one of my staff came to me and I grew this massive multinational like food, cheese, meat, beef distribution, business. Ended up selling that company. And the reason I sold it is because one of my sales managers came to me and said, Cole, people can't afford our food anymore. Our prices are too high. Our prices on Parmigiano Reggiano or Gorgonzola or Prosciutto di Parma are too high. People can't afford it. Only those that can afford to shop at Whole Foods can now buy our food. So healthy meant you had to be wealthy. And I thought, maybe I'm in the wrong business. Maybe I need to move to the financial industry because people aren't growing their food or foraging for their food. They're buying it with money. So it's true that if you don't eat, you die. But if you don't have money, you don't eat. So I recognize that as a founder and as a person that's obsessed with value, I needed to move into the financial industry. And that's where I've been for the last decade now, offering value essentially to money. I discovered blockchain technology. I felt blockchain would democratize capital markets. It would help move a lot of the wealth from downstream a little bit. And using blockchain and now artificial intelligence to do that. I was the first person to tokenize the life insurance industry of all things. I thought that was a great use case. I did have some experience in blockchain with one of my food businesses in that I was storing RFID ear tag information from beef cattle on the Ethereum blockchain. And I ended up selling that business to the Canadian Food Inspection Agency on the tail of a Listeria and E. coli outbreak. My technology and centralizing and capturing this data through distributed ledger technology ended up being kind of this immutable source of truth for the Canadian government when they were doing these recall processes of this beef around Canada and the US. And that's what led me to blockchain, to understand that, there are really good use cases for blockchain, but not many. And I discovered that life insurance was actually a very good use case for blockchain, and built that a company called Infinio, which I sold and exited that business about 1.5 years ago. And now I'm firmly planted in which I think is the best use case for blockchain, which is you and I probably agree on to some degree, which is private credit. And that's where I am today. I tried to cram that in as much as possible.
That was incredible. So first of all, let's go back to the food space. I think that blockchain is an incredible technology that people don't know how to apply for a real solution and adding value. And what you said was, hey, what if we can store the data from cattle to help prevent the next outbreak or to reduce the possibility of the next outbreak affecting people? So that was the first one. The second one was life insurance. Talk to me a little bit more about that. What specifically? So first of all, what is life insurance? Let's start there. Second, let's talk about when you mentioned life insurance, people would run from you. And then when you mentioned blockchain, you became the most interesting person. So talk to me about, like, what specifically it's life insurance. What's the value specifically that comes from blockchain? Because it's very clear when you say like cattle outbreak and diseases, especially after 2020. But like, what is the real value from having a life insurance minted on blockchain?
Right. That's a super good question. And it was so interesting when I discovered that life insurance was a really good use case for blockchain technology. I started to research. I wasn't from the life insurance industry, but I started to research life insurance, and I researched, and what I found that life insurance is not very popular. A lot of people really dislike it. The way it's represented and sold, unfortunately, is pretty poor. And I think it's very misrepresented and very misunderstood. So I also saw that as an opportunity also to market it and educate people about the real economic value of, this financial product called life insurance. And, what led me to understand that it had good utility for blockchain was discovering something called the infinite banking concept. And I read a book many years ago about the infinite banking concept, and the infinite banking concept was a very credible, I would say, first principled approach to using a life insurance policy, quote unquote, as a bank or as a warehouse of capital. It's a very specific designed type of life insurance policy that is related to what would be whole life insurance, and a dividend that a whole life insurance or a non-stock type structure would pay off. And I recognized very quickly that, in blockchain and in capital markets using blockchain, or even in crypto, there's this whole kind of unbanked kind of philosophy where we can use blockchain as a bank or as a warehouse of capital, or a way to kind of disintermediate or be libertarian or kind of Austrian economic kind of, in our thinking. And so it was this kind of collision of this unbanking kind of community, this libertarian kind of thinking, this idea of infinite banking, and then blockchain utility to use blockchain specifically use life insurance as a use case for blockchain. I can go.
Let's put it a little bit simpler.
Yeah.
So would you say that life insurance on this infinite banking concept was, hey, you could use life insurance as collateral for a loan?
Yeah.
That's the concept. Or
yeah.
It's between these two concepts.
Yeah. And I still practice the infinite banking concept in my life. But yeah, I fund life insurance policies, and I essentially do exactly what you said, is I use them as collateral for a loan, and that loan can actually come directly from the life insurance company.
What is the benefit of having it, let's say, invest in the S&P 500 as opposed to investing the S&P 500 money within the life insurance? What's the technical difference there? Because I feel like that's where the real value comes.
So for me, I don't personally look at life insurance as an investment. I look at it as a warehouse of capital. I look at it as a place to, instead of having all of my money in a bank, I like to also kind of spread that out and kind of hedge my risk in case there's a bank failure or a bank run, have some of my capital in other places. Some people put it under their mattress. Some people hold it in gold. I like to be liquid. And I think my life insurance policies are relatively liquid. I believe in the stability of the life insurance companies that are managing my money. That economically, they've been very sound for, many, many decades. And yeah, so it's just a matter of just kind of leverage. Yeah. Policies.
Is there any tax advantage to having it that way?
Yeah, this is a big part of it. Is that life insurance is the most tax advantaged financial vehicle in the world. Really, in most countries agree on how the tax treatment of life insurance. So the death benefit ultimately, and I don't necessarily own these policies for the death benefit. I look at the death benefit as a bonus for my families is paid out tax free. The loan that I'm receiving is also not taxed, but I mean, it's a loan. So I mean, loans are in any case ever, anywhere, not really kind of taxed, anyway. And I have the ability to pay the loan back and then receive the money out of that. Now, there are certain thresholds and there's certain environments, and I won't go into it because it gets kind of complicated, where they could become what's called a modified endowment contract, and the life insurance policy could become taxable if you're really not kind of using it properly, or you get offside in the ratios of cash versus the life insurance piece of it. But, all this to be said, it ended up being a wonderful use case for blockchain. And, the company is, Infinio is still running today, and they're extremely well run and well managed and doing remarkable things.
What is the single biggest benefit of having blockchain in it? Walk me through an example.
Just speed, the idea of kind of replacing, with any type of a capital market, you want to try and get away from this idea of trust. There's so much trust kind of embedded into capital markets. And if you can replace truth for trust, we're going a long way to kind of democratize and move things. Like why you talk about finance bros and the Wall Street people that, there's a lot of people in the financial industry that are kind of like inherit, these opportunities. It's because it's this like kind of like closed system of trust. And the thing that I love about,
trust for truth, right? Not the opposite way. Trust.
Did I say backwards?
I just want to make sure that the people in the background are not confused. Cause I know,
okay. Yeah, I may have said it backwards. Sorry. You want truth over trust is, and I may have said it backwards, but yes, you're right. Thank you. But it's very important that, even in the life insurance industry, the advantage of blockchain is that you are able to settle quicker. You're able to have less costs baked into the product essentially that you're buying. When you're relying in capital markets on a trust-based system, there's a lot of risk that's baked into that. You're paying for a lot of risk. There's a lot of when you underwrite and you just are based on trust. Well, what happens if the handshake deal essentially, or the paperwork that you have doesn't hold up? We saw that happen recently in the private credit space. We saw Tricolor and we saw First Brands, and we saw hundreds of millions of dollars corrected out of the industry because lenders were lending on trust. Now, if they were lending on truth, they wouldn't have these issues. And blockchain.
Let's move on to a topic that you talked about, which was the recent frauds, which they don't look so recent now because people seem to have forgotten it or put it in their shelves. When did you realize that there was an issue within private credit, and why did you say it is the perfect timing to go solve it?
So it starts with global financial crisis. It starts with Basel III. It started with all the I had just entered into the financial industry. It was all the banks stopped lending money. So all these non-bank lenders started coming in and lending money. So therefore that's what private credit is. Private credit is just non-bank lending. It just seemed inevitably like that there was a bubble, and eventually that bubble would break. And when I left and exited Infinio, I recognized pretty quickly that I needed to, obviously I'm a founder, I needed to set my talents, somewhere. And I recognized pretty quickly that there would be a potential solution using blockchain for private markets. I mean, I also have to back that up by saying that small and medium businesses are my true passion. It's very, founders and small and medium business owners are very misunderstood. They're it's a very lonely place. It's very difficult, in business. And I've always been driven to serve this group of people. And I felt that in private markets and in private credit, wouldn't it be nice if I could get work towards a small or medium business who needed a merchant cash advance to pay a factor rate that was less than like 6, which is a 60% APR, which is insane, which is a death sentence for a small, medium business in a lot of ways. When they got to borrow money at 60%, it's not fair in a lot of ways. And I would widely believe that a lot of the lenders also believe that, but they have to charge that because the amount of risk that's baked into, a lot of these deals. So wouldn't it be nice if we lived in a world where a small, medium business could pay 30%, which is still nuts, or 10%, which is a bit more manageable, right? And again, this kind of gets back to the same thinking I had in life insurance where it's the truth versus trust, thing. And we could have a more democratized private lending market, where rates came down because there was less fraud. And then, so I started building all of this technology to reduce fraud essentially in private markets. And then Tricolor happened, and then First Brands happened, which is horrible, but it just made me look really smart. Essentially, it was just like the worst and best thing that could happen because so many people were harmed by that. But it just really legitimized my thinking that this bubble was going to burst, and it has.
And so what specifically did you think the opportunity was, and how did you connect opportunity with the product that you're offering?
I thought the opportunity was to move non-bank lending on chain. Now, I also have to clarify that there's someone in the industry that is doing this, that I look up to as a mentor, and is someone who I've got to know and really admire, which is Mike Cagney from Figure, who was one of the founders at SoFi Bank. And so, Mike has kind of, and Figure have really written the playbook on this. And, he's doing, a lot of this already for HELOCs, looking at mortgages, and he's also going down the tail of private credit. So, I didn't come into this being fully innovative, thinking that, trailblazing. I was able to look around at some very well capitalized, very successful people who were thinking in a similar way, and kind of, but it's still early, really, in a lot of ways, but yet it kind of de-risked a lot of my decision making and deploying capital into the space because there was already someone doing it at scale as well. And so that was, a lot of the answer to your question about, say, product market fit for this was based on looking at what Figure is doing and some of the success that they're having by issuing home equity lines of credit in, like, I don't know the exact number, but they do it at a fraction of the cost of their competition because of blockchain, and a fraction of the amount of time. And it's, they're a publicly traded company. They're fully audited. I mean, it's fully legit. I mean, that's just the beautiful thing, really, when we talk about blockchain, is like bringing blockchain into the daylight and really applying it to, real world traditional financial assets versus what was like crypto or all these like strange coins that were kind of backed by nothing and meaningless and kind of like, essentially gambling. So, it's nice that we can use the technology for something good.
So what exactly is the product that you're building? Describe it to the audience. Like,
Sure.
How did it look like before, and how does it look like now working with you?
Yeah, essentially what we build is infrastructure for non-bank lending. So that would be everything from all of the legal infrastructure that's tied to all the legal documents. We use artificial intelligence to make that much smoother. We have an underwriting tool that, say, collects all of the uniform commercial code data that can be cross-referenced in a data lake tied to Pacer data, and a court listener, which is all the bankruptcy data, county tax lien data, FICO data, federal tax lien data. I mean, any kind of data that would be relevant to underwriting a loan is all kind of aggregated in one central place that you can just input an entity and get an output of a graph that kind of shows the relationship between the borrower and all of these things I just described, which surprisingly is really unique. It's remarkable that no one has built that already, but that's one of the things. We call that the risk engine. The other product that we have is essentially what we like to call eVaults 2.0, which is a custody layer for perfected assets. And we only perfect assets on chain through something called Uniform Commercial Code Article 12. So our technology is called CERT technology, which stands for Controllable Electronic Record Technology. So again, think of it as the evolution of the lien process, providing super perfected. And that's not me just coming up with like a fancy term saying super perfected. This is the actual legal language that 35 different states adopted to describe putting your asset, perfecting your asset on chain versus on paper. And like, I think this is, you and I've spoken about this before, but like, this is the biggest thing. Like, if there's any listener that is adjacent to anything that we're talking about or has any real interest in, blockchain use case, especially in America. And I know your podcast expands the world, but especially in America, Uniform Commercial Code Article 12 is like the number one thing that everyone needs to understand that people are just starting to talk about. And it has a massive impact on.
Why do you think people are just starting to talk about if it's something that has clearly been for a couple of years?
I think, I think people are just starting to talk about it because on June 3rd, New York State just went live with it. And, that's a big deal. Delaware is live, which is a big deal. California, Florida are all adopted. 35 states have adopted Uniform Commercial Code Article 12. I think it's just because the income, like the people that are kind of doing this, again, the financial industry is kind of this old boys club built on an old kind of system, and this new regulation, which is very fundamental and underpins really all of private lending. And private lending is a multi-trillion-dollar industry. Around I think $10 trillion around globally, essentially. And a lot of those assets are originated out of the US. Let's just be honest, like a very high percentage of them. So the lien system is a very protected system that a lot of big financial institutions do not want disrupted. I mean, it's crazy to think even in Delaware, where most entities are formed and a lot of all liens are tied to entities. It's next to impossible to get a very clear picture of lien specific entity information out of Delaware without jumping through a whole bunch of hoops. I'm not a conspiracy theorist, but it's almost like the UCC 1 financing statements are almost intentionally opaque in a way. I'm not a conspiracy theorist, but the more I learn about this, the more I'm kind of starting to wonder, like, what the heck's going on here?
Well, if you do find out, then please let me know and we'll do another podcast. So let me summarize it. The first product is you're taking a lot of databases that are clearly not on chain. They were not natively on chain. And you're saying, hey, I'm going to create a data lake for anyone who needs access to this to say, hey, if I'm looking up for an asset in Delaware, I can find that asset then in Florida. Or if I have a VIN number registered in one state in like one UCC, I can then figure out whether it's already been registered previously or not. So the first one acts like as a data lake, kind of like as a database to find information regarding assets, who's been pledged to, etc. And then the second one is, hey, given that Article 12 and it talks about control, how do we separate the layers between what needs to go through the legal framework versus what needs to go through the blockchain network? So how have you split up these two layers, the legal one versus the blockchain part? And the reason why I ask is a lot of times when I explain people what we do with Vaas, everyone thinks you're using blockchain. And I'm like, no. Like, blockchain is a technology. Like, if I go to a judge and I say, hey, I have this NFT, I have this token, the judge is going to say, lovely, great about your technology, but show me the real work. Show me the real paperwork. Show me the real legal part of it. So, and I think what I find very interesting about you is you have this background, which is the blockchain part, also the traditional finance, which is the life insurance. Now you're coming into the traditional finance, which is private credit, and you're merging these two. And there aren't a lot of people that understands both the DeFi world plus the traditional finance world and is able to merge these two concepts into what Article 12 allows you to do. So can you explain us a little bit about how you've split these things, and where do you think that perhaps either lawyers or the traditional finance industry doesn't yet understand from what you're offering? And when do you think they will grab it?
Yeah, really good question. Yeah. And I love what you said about blockchain. It's so refreshing to hear people speak to the actual utility of blockchain, because there's not a lot, but what it does do, it does it really, really well, but you just don't really need. My question to a lot of founders, like young founders, when I'm talking to them about these like blockchain or crypto businesses, my question is always, well, why do you need blockchain for that? Like really, like what do you really need that for? Like, is there another technology that can do the same thing that's, better potentially? I mean, and often there is. And it's weird for a lot of people to hear that from me because I'm kind of a blockchain guy, but I don't think it works really well for like a lot of stuff. And so to your point, the only thing like at my company right now that we do that's blockchain related is the UCC 12 stuff. That's it. I mean, we don't touch blockchain for really anything else. The risk engine is just it's just a data lake, and it's AI mostly. We just run algorithms against the data to have it tell us a story about the risk of lending to this per business or not. The other product we have is called Rail, which is a real AI legal. Rail essentially is, we have a partnership with a law firm out of LA called Ultim Legal. Our chief legal officer is the founder of both businesses, this business and that business. And we use our law firm at Ultim Legal as a way to keep a lawyer in the loop, but also run very efficient private credit documentation like master repurchase agreements or control agreements or regulatory documents like Reg D docs or, Reg S or Reg A docs. And so we just basically have this like interface where you have a drop down window of the asset, the jurisdiction, and a few other simple like clicks. And then the tool essentially spits out all of the documents that you would need. And then you engage a lawyer for final sign off. So it saves massive amounts of legal expenses, time, and energy. And it's just a great use case for AI. As anyone knows, law is being heavily disrupted by AI, and we're just kind of there as it relates to private credit. Again, no blockchain at all. There's nothing blockchain related. The risk engine has nothing to do with blockchain. But when we get into the CERT or the controllable electronic record technology, yeah, there's a blockchain component to that. And part of the reason why we use the blockchain there is because the Secretary of State in 35 different states says that if you use, essentially, to paraphrase, they don't use this exact language, but I'm paraphrasing. If you use blockchain or an equivalent technology, you receive a super perfected interest, in that loan through control, it's called. And so there's a great use case, and it's the government says straight up that if you use blockchain for this, then it's better. So we'll use blockchain, for it. And that's really it. Those are really the kind of the primary products that we offer. And of the three, there's only one that really works well with blockchain.
And so this product specifically, an eVault 2.0. Yeah. So do you see a world where these analog eVaults have to come online for a certain way for it to connect to the blockchain part, right? Because like the way that I think about it, where it breaks is, let's say you have the control in the blockchain, but in reality, the analog eVault may receive a request from whoever, let's call it at this point, to say, hey, change from A to B and notify the end borrower that it's changed from A to B. But the blockchain still says A, the judge will go with B. Actually, I don't know if they will be, because I think maybe that's where it goes to court and they're going to go do a bunch of testing. But that's where I see probably the majority breaking, which is because we see a lot of in Latin America. A lot of the custodies, and the majority of them, especially the big ones, they don't have APIs. And so it's a lot of clicks to do any types of changes. And those clicks, a lot of times, again, because a lot of that is analog, you won't necessarily have traceability going back to the blockchain saying, hey, now that belongs to a debtor B. Where do you see the definition specifically of how would you define control within Article 12? Like, what does it mean technically?
Yeah, this is a conversation. Like, I love this question so much. It's the question we get asked the most. And I answer it this way. And some people get this answer and some people don't. But people that have been around crypto or blockchain long enough will get it. Do you remember the saying, not your keys, not your coin?
No, because I've not been that blockchain girl, but I get what you're saying. Yeah.
I wish I wasn't that blockchain guy, because I kind of came up around in that world, and I saw too much
then we
crypto
wouldn't be here. We wouldn't be here if we weren't.
Yeah.
So.
Yeah. I've lived in the Bahamas for many years. I lived between the Bahamas and Miami, and I was literally neighbors with a lot of the people at FTX when it crashed. And so that was like crypto bad. I was in the ground zero of watching that all implode. But so what not your keys, not your coin refers to? It's a saying in crypto where if you have the keys, if you have the cryptographic keys to the coin, which is the asset in this case, and it could be Dogecoin or Bitcoin, Ethereum, or a real world asset, tokenized private credit loan, right? Regulated actual real asset that you could have. It's the same thing. It's kind of like having $100 bill in your pocket. Unless you can prove that, someone could prove that you stole that $100 bill out of their pocket and put it into your pocket, it's likely a judge is going to say, well, if you have the $100 bill in your pocket, it's probably yours. If some person was to walk up to you on the street and say, hey, do you have any money in your pocket? And you say, yeah, I have $100. And they say, hey, that's mine. A judge is probably going to say, no, Valencia controls that $100. It's in her pocket. So let's just let her have it. And that's really just what it is. I mean, when you tokenize or perfect a loan, or an asset on chain, you get a cryptographic key. When you turn it into an NFT, you get a cryptographic key. And if you hold that cryptographic key in your wallet or in your possession and someone tries to take a claim on it, double pledge it, or create a negative covenant, the judge is going to say, well, who has the control? Who has the key? Well, I do. It's right here. Well, and the judge is going to say, well, if you have it must be yours. And it's just really that simple. I mean, and that's where the word control comes from.
And I think that specifically for everything that it's natively on chain, call it cryptocurrencies, I think it's very, very simple to define it that way, right?
Yeah.
But as soon as you get out of the crypto world, when we have these discussions about e-vaults, UCC perhaps on Article 9, how are you thinking about control within that concept? And because honestly, my take would be everyone should just move to Article 12, regardless of the type of asset, right? Like literally regardless of the type of asset, everyone should move on chain. And that's not going to happen. That's going to take time, etc. So how are you thinking about it on a day-to-day basis when you're talking to clients, when you're talking to banks, when you're talking to lawyers? How are you guiding this conversation for them, especially for everything that is off chain?
Like, anytime there's innovation and change, there's a lot of friction. And we live in this kind of world of what I call digital derivatives or digital twins, where we're going to have a time and a space where there's like two of everything. There's an analog version and a digital version. Eventually we will just be digitally native, and there'll be an end-to-end digitally native system. But today, like you just described it so well, we're going to live in this world of friction where we have an analog version and a digital version of it. And it's about the companies today that can bridge that gap and best kind of educate people and provide certainty, and kind of hold their hand into the future are the ones that are going to be the most successful. And the way that we do that and the way that we think about that is by offering essentially free tokenization of real world assets to our clients. We don't charge them anything. We offer a foundation called UCC12.Foundation, where it's a free registry for your analog asset. You can tokenize it for free using our platform and register your asset, which is now exposing it to the benefits and language of Uniform Commercial Code Article 12, because you actually have a tokenized representation, of that asset. So if there's ever a negative claim, double pledge, or covenant on your loan, you can at least stand in front of a judge and say, I did tokenize it. I did super perfect it. And now there's no precedent yet, really. With UCC 12, it hasn't been in front of a judge. It will, happen. But we believe that this service that we're offering is helping with that transition and that awkwardness. We're not out trying to make money, trying to, educate our clients really on the importance of, tokenization. And we don't mean tokenization, because when people talk about tokenization, they think about some liquidity or some cheap money or some leverage that kind of magically just appears. No, we're just saying just tokenize, just to perfect, just to have more control of your assets so that when this becomes the new normal, you're in line for the future.
So the ideal client should go to you and say, hey, Cole, let me use your eVault so I can do that origination. And we won't have that issue whether the eVault is different from the blockchain, because you have all of that information sitting right now within the RealPC infrastructure, and there shouldn't be any difference there. Is that the best way for customers to approach you today?
Yeah, that's the best way to do it. And we would also suggest that they do. It's kind of unfortunately redundant, but we live in this world of two things. We live in this world of TradFi and DeFi, and a lot of prudent originators are going to have to do both. They're going to have to file a UCC1 financing statement and turn their loan document into an NFT, which is not very difficult to do, by the way. I mean, I think just to practically speak about that and what that actually means, it's like I could take my cell phone, I have a notepad here, whatever scratch I have on this notepad, I could turn that chicken scratch on a notepad into an NFT using my cell phone. It's just a matter of going into the Notes app, scanning it and OCRing it up to the blockchain of your choice and minting it. You now have an NFT. I mean, anyone can do it. It's not, there's a whole bunch of legal wrappers that have to go around that to turn it into a tradable, real, perfected thing. But just an NFT on its own merit is not difficult to do. And I just wanted to because people hear these things and they go, oh, well, what magic has to occur to turn a loan document into an NFT? Well, you can do it on your phone.
Let me ask you a weird question. So what happens if someone right next to you goes and takes a picture of of the scratch and uploads it into a different thing, what happens then?
So that's a super good question. And that is like, I love that. Well, they wouldn't have all the legal wrappers with it, right? So
Okay.
what would have to come with that is you'd have to have, there's a whole compliance layer where you'd actually have to prove that you have to have, there's a whole legal wrapper that still has to occur. Yeah. And that will still happen until this is done digitally native. Because when the loan is born on chain, none of this is all, there's no question that while we live, because your observation is right, that will happen. Right. And that's why we created this foundation, this registry, is so we want people to pledge all of their loans on this registry. So in case another lender wants to go and lend against this piece of collateral, all they have to do is go to our registry and check to see if someone's already loaned against it or not. And I think that's we have a very unique opportunity to get this right and create a new normal out of the gate. And why we ran it as a foundation is because if we ran it for profit, then everybody wouldn't use, and we want everyone to use it because it kind of gets back. We'll make money in other ways. We'll make money on the data alone. The data will be ridiculous. I mean, we're here to make money. But if we create this registry for free, then people have no reason to not use it and to register all of their super perfected UCC 12 loans to ensure they're not going to get negative covenants, double pledges, a repeat of tricolor or first brands. And it's a great way to reduce fraud in the industry.
Cool. Let me ask you something. So when people are registering through your tool, is that data becoming available within UCC for everyone to check, or it's becoming available within your data lake that people can check?
Anybody you don't have to be a member or subscribe. If you're a loan originator and you would like to see if an entity essentially an entity would issue against a UCC 12 against a borrower, they would be able to come into our registry and see that. And all the PII is hashed. And
that's where I was going to next, because my previous question to that hash is the data available only for your clients, or is it like anyone within the blockchain world registering out?
That's not even on chain. It's just a database that's available publicly.
Yeah. Okay. So, and then
and to it as well. Like anyone can get to it as well.
Everyone can go into it. Got it. So let me ask you that question about PII, because that's where I think the next layer also it becomes very interesting. And as an industry, we need to figure it out. Let's say I am a lender and I go to borrower A, and borrower A says, don't worry, I've already registered within RealPC, you can check it there. Okay, great. I'll go check it. What data am I specifically checking for, given that there's a hash, because we don't want PII just being thrown out there? And then how do I make sure that, yes, I do find that this hash is available within this, but then how do I know that it's not available in another blockchain? Because at the end of the day, if I only have the hash and I don't have the underlying data to go out to view to all different public databases, how am I going to search for what I'm searching is actually real?
It's the bang on right question to ask. And this is the biggest issue and the biggest risk with UCC 12 is how many different blockchains that we have that are out there where all these assets. And so what's to say that, again, this issue is very real. And this is why we're creating this central database is to create a very unique cryptographic representation of these loans while we live in this gray area of digital derivative or digital twin. It's going to be very complicated. When we're digitally native, none of this will matter. This won't be an issue. But until we get there, we're going to have two copies of the same asset and an entire world that's primed for fraud, worse than it is even right now, and double pledging because of what you just said. So the way to achieve that is to have one central registry of trust and truth. Excuse me, I got to figure these T words out. You keep correcting me right, that everyone, the industry kind of agrees that you have to register your NFT or your hash, here.
Can I tell you an idea? I've been studying this for the last couple of years, and I have found the best registries that have worked is when it is fully public or government generated, or there's a quasi-government. It doesn't work when it's fully done by the private markets, without any like government standing coming in. If you look at, for instance, Colombia, Peru, Chile, Brazil, Mexico, they all have the receivable being stamped by the government. Every single invoice, no matter how small, no matter how big, $1 up into millions of dollars, they have to be registered by the government. And that's only an API request. And there's this infrastructure that has been created. The US doesn't have this. China is looking to have this, or at least I've heard that they're looking into having this. But what you see in 100% of the cases, except for Mexico, because it's not considered a negotiable instrument, the receivable, is that it's the government that controls it, except for Brazil. So Brazil does have this quasi-government where they created like multiple entities that they didn't create it, but they allowed multiple entities to be sort of that custodian. But if you look at Chile, who has probably the best factoring market in terms of these, is the government controls who's the actual owner. But there's all these third parties that are connecting to that database. And so I think government needs to be included only for a very small part. It's to connect everyone and to make sure that when it goes to a judge, the judge says, hey, I think there is something to where I can check, and not a private blockchain that no one has heard of because it was just created. And yes, you do have control, but then you don't really have control because you have blockchains or you have control in two blockchains. That's where I think it gets weird. But
100% agree with you.
Go.
I was going to say 100% agree with you. We should talk offline. Maybe that's something that we can work on together. Can you imagine that exists all over Latin America, this system, and it doesn't exist in the United States?
Well, it already exists. And it exists since like 2014, 2016. And Chile's GDP is incredibly like...
In Latin America, it exists. But in the United States, it doesn't exist.
No. The U.S. is incredibly behind. And this is what I'm telling people. But people don't like to hear it.
No, we agree on this. And this is on our roadmap to build this and to work through a government API so that they can have like invoice verification, even just with trade finance, like invoice factoring, supply chain, payables, receivables. I mean, this is where all the fraud is. I mean, why the heck doesn't this exist in the United States? And this is government good, not government bad. I totally agree with you.
Yeah, I think there is a possibility for private to be fully private, but it needs to be like, you need to have everyone come in and do it. You know what I mean? Like everyone needs to do it. So that's where you get the efforts.
Yeah. It needs to be regulated though. I agree with you.
At least one small part. Because if you look at how it works, it's like there's a lot of private companies attached to it, but it's just the government that creates the basic infrastructure to make sure these questions are answered. Let's go back before we touch on are being audited against the actual value held, which is the dollars or the money market funds or whatever the investment is that is pegging or doing that one-to-one peg. It needs to be audited on a monthly basis. And that to me is incredibly concerning. And at the same time, I have a lot of, what do you call it when I have conflicts of interest because I'm clearly like the one that it's auditing the most. So I want people to audit faster and more. So there's clearly, I have a bias for it. What are your thoughts specifically that you have come from both traditional finance plus DeFi with the fact that one of the biggest legs for everything to be on chain is cash flows and payments, right? Like that is one of the biggest ones. I think we've already seen on-chain origination, but on-chain payments, unless it's on the on-chain world fully, we're still not there yet. How do you think about it? Do you think that this needs to change? Do you think monthly is okay? Do you think that there's bigger questions to be asked about the Genius Act that the Clarity Act does not specifically are discussing it right now?
Right. I think I love this question. And again, there's another thing that there's an answer to this question that no one really is talking about already that's out there. It's kind of like the UCC 12 thing, which is, and it gets me back to what Figure Technologies is doing. I mean, Figure has a stablecoin that no one knows about that is the only SEC approved stablecoin in the world. And if I think I'm understanding your question, properly, that this whole auditing of stablecoins, the backing of stablecoins, I mean, the stablecoins are no different. And people love to, criticize banks. There's a lot of reasons to criticize banks. Banks are fractionally reserved. I mean, therefore, there is bank run risk that is very real. We see banks fail all the time throughout history, because of it. Now, the same thing happens with stablecoins. If stablecoins are backed by kind of like the fiat M1 system, are stablecoins any better? It's a really good question. Are they audited? I mean, there was all this like controversy many years ago about Tether and being backed, and there was a run on Tether, and then Tether met the redemption. So clearly they were backed, and right. So, but who knew? I think Tether is like the most amazing company in the world, truthfully. I also think that Figure is one of the most amazing companies in the world, and Figure have a stablecoin called YLDS that is SEC approved. It's highly audited, it's highly scrutinized, and it's yield generating. It's the only stablecoin in the world that pays the yield back to its holders, right? It's like the most transparent, backed, non-fractionally reserved, yield-bearing asset that's out there. But again, people talk about USDC, they talk about USDT. There's, what's Ripple's stablecoin, RLDUS or something like that. But YLDS, to me, YLDS is the answer to it. So
what is YLDS? I don't know.
YLDS is the Figure stablecoin.
Got it.
It's SEC approved. It's the only SEC approved stablecoin, and therefore they can push the yield because it is a security. They can push the yield back to, it'd be like a bank offering, it's literally if you think about it, it's a bank account that is not fractionally reserved, that gives you, it's like a checking account that pays you 3%. I think the yield on YLDS is close to 3%. That's crazy. It's like a checking account paying you 3%. That's not fractionally reserved.
What do you mean like non-fractionally reserved?
Meaning so fractional reserve banking is like if you go to your bank, and make a deposit into your checking account, you put your paycheck. And this is before Basel III or the global financial crisis. The banks were leveraged at something like 15 to 1. I can't remember exactly. So for every dollar I put in the bank can lend to whoever they want $10. Now, if everyone that had money on deposit at the bank went to the bank on Monday and said, we want our money, the bank would go, bank.
Not capital. Yeah.
Because they wouldn't have the money because they're fractionally reserved. They only have what it means is that the reserves they have a fraction of the money that you give them on reserve.
You're saying like SoFi doesn't use the capital from these stable coins to lend money.
Figure,
sorry.
Correct. Yeah. It's backed. So they have, it's backed by, it's publicly traded companies. So you can research it, but I don't know what it's backed by, but I imagine it's like backed by like treasuries.
Okay. And so treasuries is basically the way by which they invested in treasuries and then they pay out the treasuries. Okay.
And they pay out the yield. Yeah. But think about stablecoin. If you own a stablecoin and you're not paying yield back to your stablecoin owners, so people are giving you, and if you're backed by treasuries, think about what happens when the yield curve inverts. All that means is the stablecoin issuer gets super, super rich because all of that yield is coming into their pocket because these treasuries are very short term. They mature and pay out a huge yield that the stablecoin issuer does not need to return back to their subscribers. It's a fascinating, I know some people that have gotten very, 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 very rich very quickly because of yield curve inversion, and they were stablecoin issuers. It's amazing. I mean, good for them.
But then the opposite can happen, right?
The opposite can happen, but they're hedged still 1-to-1 at the price of fiat, right? So they wouldn't ever go underwater. They would just make less money because essentially the treasury, basically the coupon on the treasury will just be less. So they're not making negative. They're not going to go into the hole. They're just making less money.
And so where do you think the discussion right now regarding Coinbase, Jamie Dimon's full of shit comment to not sure if you saw it, but basically it's like the Clarity Act, like banks don't want it to go through. What do you think it's the biggest argument for the banks to say, hey, there's clearly something unfair. Let's talk about it. This needs to be talked about. And then what's Jamie Dimon's like full of shit, like the opposite. Where is he full of shit and he's not bringing it up forward? Where is he not being like upfront?
Yeah. So the reason the banks don't want it to go through has a lot to do with what I was just saying, that it would, like, if the Genius Act went through, Genius Act, Market Structure Act. Yeah, it's the Clarity Act, excuse me. The Clarity Act went through, then people would stop depositing. There would be more YLDS because Figure has already solved this. I mean, it's just kind of funny to me that more people aren't talking about it, but there would be essentially stable coins would be able to pay yield back to their depositors, their subscribers, the people that purchase say USDC. It would be like, and then they would just stop depositing money into banks and the entire banking system would collapse because the banking system is dependent on, it's a deposit-based system. So if retail stops depositing money, like their paycheck, and warehousing their capital, because if you think about capital, essentially, just capital has to exist somewhere. And like, well, where do you want your capital to exist? It could exist. I have my capital. A lot of it exists in life insurance policies. You could have it exist in a safe. You could have it exist in a stable coin or a bank account. Now, what happens if your stable coin paid you a yield much higher than your bank account and also gave you more flexibility? Like, have you ever put money into your bank account and tried to take it out? I mean, you could have $10,000 in your bank account and your bank will ever only allow you to take $1,000 increments out of it like a week in some retail cases, right? Which is insane. And the only reason they do that is because they know they're reserved and it avoids the bank run. So this is a big reason why the Market Structure Act hasn't gone through, is because stablecoins are a direct threat to systemic banking system.
But where do you think Jamie Dimon's concerns, where the banking system's concern, is actually real, that Clarity Act is not addressing?
What is he talking? Maybe I'm not up to speed on what he's been recently. Like, maybe I'm not polished up on this. What's his beef?
No, so it was such a good beef. I think it was like last week. Basically, like Jamie Dimon was on an interview, I can't remember where, and he said that the CEO of Coinbase was full of shit. And that the banking system was not going out just like without a fight regarding the Clarity Act, et cetera. I'm not entirely sure what their specifics on his concerns are. What I can tell about the concerns, and I've talked about it, there's more podcasts coming on about this, but if you look at private credit, the majority of private credit, if we go by your definition of non-bank lending, is you do have a ton of questions being asked, whether the assets are real, whether the assets are actually pledged to the right holder, whether the cash flows are being reconciled. So you have this, like, if we have this private market system and all of this is tokenized, and it is Coinbase or is USDT or USDC or the token that someone is originating, can they use this token as a collateral for a loan, right? Is it just money markets allowed? And if so, well, everyone is investing in money market, the U.S. treasuries, no other treasuries in the world, just U.S. treasuries. And they're all capped at the same amount and with the same amount of leverage. And I think everyone competes under the same conditions. Now, but what happens if you stay away from that or you move away from that and you go to like a 1-year bond or a 10-year bond? Are you allowed? What do you have to have reserves or you don't have to have reserves? What happens with the compliance the banks have to go through that stable coins holders and no one else has to go through? And I think, like, I've been following his annual letters, and in a couple of years ago, he was like, I think it's very unfair where banks have to have a lot more scrutiny than anyone else, including fintechs. Now it's regarding more crypto. It's like, okay, we all need to compete on the same field. Like, if you want to be full crypto, then let's do it. But then how, as a bank, if I have deposits and now they're also going to have deposits, why are we not treated under the same conditions? And I think that's his argument. I don't specifically know, but that is my argument. My argument is, why are fintechs, banks, and stablecoin deposit token issuers, why are they all held at a different standard? If supposedly we're all trying to protect Americans' deposits, all of a sudden it's like, well, is it really Americans' deposits that you want to really protect if they all have different conditions?
Yeah, right. That makes a lot of sense. And I think he has all things being equal, I think he has a really good point. And I think that was really eloquent the way you described that. And thanks for bringing me into it, because I didn't actually know that he was beefing so
I'll send
hard.
you the video.
Okay, that's interesting. I think he's actually a really interesting guy. So I'd love to hear what he has to say. Like, my fundamental thing is that, I had a guy, kind of a mentor. He's named Dr. Robert Murphy. I worked with him in my former company. He's one of the most famous Austrian economists, living Austrian economists. And he taught me a lot. I've known Bob for many, many years. He taught me a lot about what I know about Austrian economics. And the kind of school of Austrian economics would suggest that the idea of money should be sound, meaning it shouldn't be quantitatively eased. It shouldn't be fractionally reserved. If a company is going bankrupt, it should go bankrupt just to let it reset and see what rises out of the ashes. Don't believe in bailouts, right? It's just, there should be, if you have one fiat dollar, you should have the equivalent in gold at Fort Knox. This would be the idea of sound money. So I suppose then the issue with banking, and fractional reserve, like, I guess if I believe in Austrian economics, I would not believe in fractional reserve banking. And that's the modern banking system. Because they're just very, they they take control away from depositors. Average regular retail people work very hard for their capital. And when they put their money into a bank, they're instantly relinquishing control of their money and their autonomy and their liberty.
And I would argue to someone that perhaps on average, to the average retail investor, is going to know way more than them on average on how to manage that money. Because like they've at least studied it. Like, I don't know.
Yeah.
Like I'd rather give it's going to get, who do I give my money to? The FTX coin or to a JP Morgan coin? Like who would I trust more? It's like,
well, so this is the exciting thing about, like, this kind of leads us to the beginning of what we were talking about. This is the really exciting thing about what's going on right now, is that I believe the average person is going to be able to deposit like a lot of their money into their Robinhood account and start to behave and act like a hedge fund manager. They're going to have an agent that will allow them to go and buy these alternative assets, these exotic assets that have historically only been available to a select few hedge funds, like trade finance assets or long tail private credit assets that are on leverage to pay 20% that have very low defaults. Now, these exotic assets have only historically been available to a select few, hedge funds. And now, because of blockchain and the democratization of capital markets, the average retail person is going to be able to own that, right? And that's a great use case for blockchain. And they'll be able to own that in their Robinhood account, and they can use AI to essentially manage their portfolio, and they won't ever have to look at it. I mean, this is all like happening in front of us. So it's not just about blockchain. It's also about the risk management of owning these. So blockchain really allows these assets to be available to the average retail person. Now, it's called democratization. That's really what that word means. You use the word all the time. It's like, well, what does it really mean? That's what it means. And then, well, there's a lot of risk because they're risky. They're riskier to own. But then you have AI to manage the risk. You're basically a hedge fund manager. You're Jamie Dimon. You're Bill Ackman, right?
The AI is also a reflection of like who you are. So if all of a sudden you want to go like leverage all of it on whatever coin or whatever, like, and then who's holding on the bag if something actually hits the fan, if we have another GFC and like everyone is going to go to the government to ask for a bailout if it gets too big and liquidity stops flowing. So I'm still not yet fully on the idea that retail will control every specific aspect of like their investment, of like institutional, etc. I do think it will have more control.
Agreed.
I think there's still a way longer conversation about like, how do you protect both the end customer from either making a bad investment or the government having to bail out whatever bad investment was done, like clearly was done in 2008. So I think it's still TBD, but I'm very excited. I love what Robinhood is doing.
Yeah, I think it's all super exciting. I think it's just like very good for people. It's good for middle income, lower income, people with discipline. I mean, that's
like, I wish I would have bought Anthropic stock. When they did this whole thing in Italy about like launching the 1-to-1 thing about OpenAI equity, and then Sam Altman came out and say like, oh, don't trust that, whatever. Like on that day, I tweeted like, I wish that I could buy like Anthropic stock through the Robinhood as opposed to OpenAI.
Right.
I would have, but I couldn't because like I'm a retail investor, so who don't have access to these things. So I'm excited.
Yeah. I'm saying like all this stuff, all these SPVs, right? Like all these SPVs, like why people don't even know what an SPV is. Like we don't even need to, like, who cares? It won't matter. It'll just be available, right? It'll just be on chain. It'll be available. And at the end of the day, like people like Elon, like they're like these, I think a lot of that, like these founders and they don't care where the money comes from, right? If the money is coming in and it's going back to, this is fundamentally why I'm very bullish on AI good, not AI bad. I think AI is going to do a lot. It's going to be some pain probably for a few years, but I think generally speaking, the world is going to be a better place. People are going to be able to afford better quality food, drive safer vehicles. I mean,
yep, I agree.
The future is pretty bright, I would say.
I'm glad that we finally got it done.
Yeah. Thanks. Thanks for being patient with me.
No. Anytime. Hopefully we can do another one. Maybe we can bring the Austrian economist to talk about a little bit of if this were to happen.
I could introduce you to Bob. Bob if you Google him, he's one of the best public speakers ever.
Okay, lovely. Okay, well, hopefully we'll do one of those.
Podcast. Yeah.
there's a big topic to comment. I'll send you the video of Jamie Dimon, and I'm really excited about what you're building. I think everyone should be checking out what you're doing. I think it's very unique how you're approaching this problem, and people should be using at least one of your three products.
Right. Well, it means a lot coming from you. I have a lot of respect for what you have built and what you've already achieved and where you're going. So thank you.
Cool. Big hugs. Thank you for coming.
Thank you. Thanks for having me.
Free audio post-production by alphonic.com.